I am honored to have a very special guest join us in today's episode, Ian MacDonald. Ian has been a dividend investor for more than 60 years. Prior to retiring, he was vice president at Equifax. Analyzing the birth, life, and death of companies has been his passion for decades. Hi, I'm Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. Ian shares his 6 decades of investing experience and talks about how he got started with dividends after losing $300,000 of his life savings with an investment advisor. We talk about dividend investing, the importance of quality stocks, and how to become a confident investor. Let's get started with today's episode. Ian, welcome to the Simply Investing Dividend Podcast.
Thank you for having me.
We are so honored to have you here today, Ian. You have a wealth of knowledge, a wealth of experience. I was looking at your background. I think you've been doing this, correct me if I'm wrong, has it been like almost 40 years or more,
No,
right?
it's closer to 60.
60. Incredible. So I am looking forward to our conversation. We are going to be talking about dividend investing. You've written 6 books on that topic. There's 3 novels,
Yep.
but 6 books on this topic.
Yep.
So Ian, for our audience who may not have heard of you, they don't know who you are. Can you tell us a little bit about yourself?
Okay. I grew up in Sudbury, Ontario. I worked my way through university in the mines, and I got out, and I didn't have a job, and I had $100 left. I went back and worked in the mines, and 3 months later, I came back to Toronto, the big city, to get a job. And I took the first job that was offered to me, which was a credit reporter at Dun and Bradstreet, which was then about 8,000 employees around the world and was the primary source of commercial risk information in the world. And my job was to go out every day and talk to 11 owners of businesses. And I could ask them anything because they were trying to either get credit or insurance or a bank loan or whatever. They were quite eager to talk to me. And then I would write an assessment on them and so on. But that is the basis of my education on risk and business and everything there. Because before that, I knew nothing about business. I thought I was going to be doing this for the rest of my life. And much to my surprise, within 8 months, I was into management, and then I was into sales, and then I left and was back and was general sales manager for all products for Dun & Bradstreet in Canada, and that was the reporting and collections and publications and the marketing services division, or as general manager of that division. But I left because I didn't want to go to the States. And I got another job where I was simultaneously the same time, president of a collection agency called Intercontinental Collections. I was general manager of a research company that researched senior executives for businesses, which was a real education once again. I was given 3 or 4 months to learn all about it. I could learn about it, but it tied into my background. Then a job came up at Predatory, which was in the number 2 company in reporting in Canada. I ended up there, and I ended up as a senior vice president at one stage. And then they got bought out by Equifax. I ended up at Equifax as a vice president. So I've been doing this since I was 22. I'm now going to be 81 in a couple of months. So I've seen a lot. And then when I got out, when I retired at 60, I wanted to do something. I got into writing, and I quickly found out that when you're 70 years old, nobody wants to publish your stuff. So then I opened up my publishing company, and I've published my books and market my books and sell my books. And of course, I'm passionate about investing. I'm passionate about dividend investing in particular because it's been so rewarding for me. Does that give you a good summary?
Yes, absolutely. Thank you for sharing that. That is fantastic. I've got so many questions. Now, one of the things I noticed on your website, and we talked about it briefly before I hit record, And you mentioned that you had some life savings that were put into a mutual fund, and you did lose $300,000. Can you tell our audience a little bit about how you invested that money and what happened to it? Why did you lose 300,000?
I was, as I said, I knew nothing about investing, just like at one time I knew nothing about business. This friend, who is not a friend anymore, said to me, okay, I've got this big lump sum of money. What am I going to do with it? Oh, we can take care of that. Within 15 minutes, he had it spread among several mutual funds. And I said, how much is it going to cost? He said, so little that you won't even notice it. I said, oh, and what about when I actually retire? What am I going to do? Well, what you're going to do is you're going to deduct 4% of it every year. And it'll last you until you're 90. Okay, that sounded good. And it's safe and it's going to grow and no problem. Of course, it kept on shrinking, shrinking, shrinking. Oh, and of course, I would think I was paying 2%. So it's going down because of that. And all of a sudden, I'm 300,000 down from where I started. And this is not a good idea, especially when you think about the fact that when I actually do retire, 4% of it is going to be going every month. There was nothing built in there to get capital gain. Okay, so then that's over. One of the big things I had done in my career was design commercial risk scores. Um, which were used at Equifax, used at Creditel, and so on. The way I got into that, I had American Express and Canfor Weldwood approach me, and they said, "Listen, we want to be able to sort all of our risk of all of the businesses that we deal with from highest to lowest risk, and we need a scoring system." I said, "Okay." So I went to the two largest scoring companies in the world, Management Decision Systems, and I can't remember the other one. And I asked her, how much would it cost to get a scoring system made up? They said, oh, can't do that. Companies aren't human beings. They don't have character. You couldn't possibly score businesses. I said, oh, okay. And then I thought to myself, this is nuts, because I just finished building a database of 2,200,000 Canadian businesses. And I've been measuring everything in that database now for a couple of years, and I could see the patterns that were emerging. Companies do have character. They are not blocks of wood. They are not machines. They're controlled by people. It takes a lot of skill for somebody to be able to know what expenses to cut, to add, to how to get sales, and so on and so forth. And I said, I know that that a scoring system can be built. So I sat down and I built a scoring system to guide me in making my investments and buying my stocks for myself, not anybody else. So I put it together. It all seemed to make logical sense to me. Now, I had a friend, he was older than me, and he'd been the VP of Information Systems at Creditel. And I showed him what I was doing. And he said, oh, he said, that's very interesting. And then one day, about a week later, he comes back to me with this piece of software and says, here, I've done this for you. You can now score the stocks more easily rather than doing it manually. And he was right. I could do it in I can do score a business in about a minute. So it's that quick. And I said, fantastic. So then I set out and I started scoring the stocks I was looking at. First of all, I had to select which one I wanted. First of all, I wanted steady, reliable income. That means I wanted financially strong stocks paying high dividends. So I could use selectors. I used the TD research database, and I put the selectors in. I come back with 50 companies that are high. They seem to be good. And then I start scoring them. The score's out of 100. I don't want anything in my portfolio under 50. So I go through and I try to do a balance between the companies that are strongest, that maybe aren't paying that high a dividend, and then other companies that aren't as strong, but they are paying a high dividend. Because what I'm trying to get is a balance of 20 businesses that are going to average out to an income growth of somewhere between 6 and 8%. And that is what I achieved. Then once that's achieved, There's no, I almost don't have to touch it again. The only reason I would sell a stock is if the score fell below 50 and at the same time the dividend dropped below 5%. And then I would consider selling it. Now, how many times has this happened in the last 5 years? None. It just doesn't happen because the companies, if you look at their history, you can see their dividend payouts going up. You see their their stock prices will go up, they'll go down, they'll go up, they'll go down. But overall, they're usually moving ahead. And all of that was built into my scoring system so that I could see that. So when I get down to finally choosing a stock, it's got the right score. I look at the history, I look at the price, I look at the dividend payouts, and then I do a Google check to see is there any hidden little surprises in there that aren't going to be very helpful. I don't want to see somebody on the verge of being sued for $1 billion or something like that. So it works. And what can I say? I've lived off my income now for 20 years. I'm further ahead, many multiples higher than when I started. I take care of my wife's portfolio as well. And if you are going to do something right, you better do it for your wife because you got to live with her, right? But she seems to be very happy with what I've been able to do with her money as well. Um, and I guess that is the story. Now, why did I write the books? That's the interesting thing. I was leading a pressure group to stop $1 billion worth of condos being built at the corner of Dufferin and Lawrence in what was Parkland. And there was a woman there who was living in the old age home. She was 80 years old. And she helped me by organizing the people in the old age home to come out and hold their signs and shout and carry on against the developers. Well, we won and we saved it. She said to me, I'm very concerned. I had sold my businesses. She owned 5 gift stores at one time. And I've ended up with over $1 million. And I gave it to an investment advisor, and it's now shrunk down below $1 million. I told him all I wanted out of it was $35,000 a month, and that was it. And I'm getting my $35,000, but it's shrinking and shrinking. Can you please look at it for me and see what you see? I said, okay. So I sat down and I looked at her statement. So what did I see? I see a advisor who is selling more and buying more stock in a month than I would buy in 10 years. And each time he's buying something, it's being charged. If he buys into foreign stuff, she's being charged for conversion fees. It just went on. And the stuff he is investing in, I don't know why he was doing it. There was no capital gain. There was no dividend payments. She thought she was getting dividends. I said, you're not getting dividends. What he's doing is he's selling off a piece of your portfolio every month to give you that income of $35,000. Well, what should I do? So she was the first person that I gave my software to. Here she is, 80 years old. She's got this software, and I teach her how to use it. I must have back and forth on the internet, answering her questions, maybe hundreds and hundreds of questions that she had because she knew nothing about investing. So she picked her portfolio. I didn't pick it. She picked it. She picked the portfolio and she sat back. All of a sudden, she's getting now an income closer to $80,000 a year. And this thing is not shrinking, it's growing, and she's happy. And she phones me every now. She only lives blocks away. And she'll phone me. At the beginning, it was, Ian, such and such stock is going down. Should I sell it? And what would I say to her? I'd say, have you scored it? Yes. And what's the score? Oh, it's 60. And what is the dividend? Oh, it's 6.5. Well, why would you sell it? It's a strong stock. Hold on to it. So now she no longer phones. She no longer says she used to look at her portfolio every day. Now she forgets to look at it for weeks and doesn't worry about it. She expects the income to come in. And so I said, that's interesting. Well, I had enough. She said, you've got to do something for my friends as well. I thought, okay, that means a book. So then I started writing this book. I had been writing novels before this. I like writing novels, they're fun. Writing business books is not particularly as much fun. Anyway, I said, okay, I will write a book. And I wrote the first book. It was called uh, Income and Wealth from Self Directed Investing. Where is it? No, that's the wrong one. Anyway, it was the first book, and I put it out there. I went to publishers, and and as soon as they found out how old I was, it was kind of like, well, anybody who is over 70 is obviously senile and an idiot and doesn't know anything and blah 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 blah. And I'm not. I didn't need it. I didn't need the money. I didn't give a damn about the money. But I wanted. It's a lot of work putting together a book. So I said, okay, I will put together my own book. And I design the covers, and I do the interior, and I put it all together. And I went to Amazon, and I put it on Amazon, and fine. It got sold, and people are buying it all over the world. Germany and Dubai and Australia and so on and so forth. Except it didn't have everything I wanted. Like one of the things I wanted is I wanted to put in more of emphasis on the history of the stock, of its share prices and dividends. So my last couple of books, I've got 20 years of history. So at a glance, you can see what's been going on with that stock for the last 20 years. And is it been strong and so on. And I've got the scores going back for several years as well, because I'm doing it for myself. I use my books for my own investing. And fine. All of the money that I've made out of the books, I've never spent a penny of it. It's sitting in a bank account. Maybe someday I'll take it out. But, and it's not that much money to begin with. So that's the story there.
Yeah, that
What
is
else?
fantastic. That's a great story, Ian. I just wanted to clarify when you talked about you helped that woman with her helping her to build her portfolio. She was original plan. I'm assuming she wanted to make 35,000 per year, right?
She
That
was
was
very She was very naive and innocent. All she wanted out of her $1 million portfolio was $35,000. She had a down pat.
yeah.
Okay.
So that would be around a 3.5% dividend yield, right? To get the 35,000 per year.
That's what she would be getting. That's right.
Yeah, yeah, and you helped her to get it. You mentioned it was over $80,000
Well,
a
she's
year.
in the 70 to 80,000 range each year. Yeah.
Yeah, yeah,
But of course, the portfolio has grown as well. That's the interesting thing about it that I have found, because I spend so much time looking at these numbers, that the usually, if I have 20 stocks, I'm going to find at least half of them that the share price is going to increase every year. Now, what happens when the share price increases? And a lot of companies, because they've got pride in being able to say, we're paying a 5% dividend, that if the share price goes up, that means the dividend yield percent goes down. So, how do they get it up? They have to pay more out on their dividend, and they do. And this then keeps your portfolio well ahead of inflation, because inflation on average runs about 3.5%. So my thinking was that if I can get a return of 7%, I'm at least being well ahead of inflation, double what it is.
yeah, absolutely. So, Ian, if you talk to anybody, like any financial advisors out there, if you talk to any of the banks, they will tell you
Do
conventional
I talk?
wisdom that when you're young, uh, when you're young, you be in equities, but as you get older, you need to get out of equities and go into fixed income. What are your thoughts on that?
My thoughts on this is that most investment advisors do not impress me. They don't know a great deal about operating businesses. I've operated businesses. When I took over one of the divisions at Creditel, it was in the hole $1 million. When we got it sold to Equifax, it was over $10 million. So I know how to make money running a business. The typical investment advisor does not do that. He is a salesman. His whole job is to try to attract as many people to him as he can. He knows that he's going to lose 20% of his clientele every year, and he's going to be constantly looking for a new clientele and hoping to God that he can keep them long enough to make money on it, because he's going to make his 1 or 2% or whatever else he can get in the way of kickbacks for selling mutual funds. And there are more mutual funds sold in investing than anything else still, which surprises me. And that is where he's going to make his money. He is a salesman. At Dun& Bradstreet, I had 100 salesmen, and they, in the reporting division, they were on a draw, which is more or less commission, of 5% of their value, and they got 10% on their overage over their monthly quota. And all the little tricks that they would have to trick customers, like I have 300 reports. How many do I need for this year? Oh, you're right on target with where you were last year. But the guy is so stupid, he doesn't realize that he only used 50 reports of the 300 and he's being screwed. Okay. This is the same thing with this. Most investors are naive. They do not look at the prospectuses of their mutual funds. They've got no idea of what they're investing in. They're just blindly giving their money over to somebody with the hope, with the dream that somehow or other they're going to get rich. Now, what I like about the way I invest is if you reinvest your dividends when you get them, before you're retired, you just keep reinvesting those dividends, reinvesting. They're going to start compounding. You're now making money on the money that you put back in there from your dividends, and it gets bigger and bigger. It takes about maybe 5 years to double your money the first time. To double that again might take 3 years. To double it again might take 2 years, might take 1 year, and so on. It just creeps growing and growing like a snowball. So if you start young enough and you're disciplined, which is not everybody is, and you stick to the laws of what goes on in business, you're going to make money and you can't lose it. Like one of the things I get often is, I could lose all of my money. You can't lose all of your money if you invest in financially strong stocks. A company's sales go down. I remember one time I had the division I was running wasn't going to make its objective on the sales. And I was told that I was going to have to let 15% of the staff go. And I thought, how can we possibly operate with 15% less staff? But I did it. And what happened? The other 85% picked up the slack, and we made our budget at the end of the year. It isn't, when you're dealing with businesses, it's not just their sales that's important. It's the wisdom of knowing when to cut your expenses as well and make your profit. And it's from the profits that the dividends are paid, not from the sales. It's from the profits. So you got to watch your expenses just as much as you watch your sales.
Yeah, that's so important, right? And like you said, the dividend that's paid by cash. Like the company can't
Yes,
fake
yes,
dividend; they have to
yes,
pay you the dividend, right?
yes. Well, they don't have to pay the dividends. They don't have to pay it at all. But a lot of companies take great pride in being able to say, we've paid dividends for 51 years. Now, they may have only been paying 0.5%, but they've still been paying it for 51 years. And they take great pride in that. And it shows the stability of the business. So, would I invest in another story for you? Okay, I'm now a salesman at Dun& Bradstreet, their marketing services division. I'm selling mailing lists of executives. And I have all of these clients who are bucket shop stock promoters down on Richmond Street in Toronto. And I go in, and they would buy the names and phone numbers and addresses of every chief executive in all of North America. And they would dial for dollars day after day after day. And, this is what they were doing, saying, well, familiar with how the companies operate and what they do. As a salesman, I was making 10%. I was happy, but what am I doing? I'm causing them to phone all these naive businessmen and trying to peddle Canadian mining stock to them. And I used to deal and write reports on Canadian mining stocks. It takes about 10 years from the time that they find a property with ore in it that they're going to mine before you're even going to see that mine come out of the ground. It's a long term risk. I'm not going to invest in something like that.
Yeah,
I mean,
absolutely.
you know how shy I am about telling you what I think. Yeah.
No, that is great. I love it. I love the we're learning so much. I'm learning a lot. I think our audience is going to learn a lot as well. So from what I hear from what you're saying and from what I've read online, you're not interested, as you're getting older, you're not interested in putting the money in GICs or bonds, right?
I,
Are you keeping them in
but
dividend?
okay. I write about this in my books.
Okay.
Can you get a capital gain out of a bond? No, you can't. Is it going to pay much more than bank interest? A little bit more, but that's about it. But to me, it's just a waste of money to put it into bonds and GICs, especially if I can get, as I said, half of those 20 stocks are going to be increasing in value every year. And I'm getting my capital gain. I'm not going to get it on GICs and bonds, but most investors who invest in those things are petrified of the stock market. They don't understand businesses. They don't understand that there is a safe way to invest. And that is what I'm preaching, I suppose.
Hmm.
You
Yeah,
can, if this 80-year-old woman can do it, you can do it too.
I think that's the big thing, is that there's a huge gap in knowledge and people are very fearful. And if you look at today, it's sort of May 20th of when we're recording this. There's a lot of fear out there, and fear and uncertainty, especially with the tariffs and the tariff war. But Ian, you've lived through so many market downturns. You've lived through the tech bubble, 9/11, even before that, right? All the market crashes. What has given you the confidence to continue doing what you're doing?
Experience. Because I know when I go through these crashes, as you said, I've been through several of them. What happens to my income? Nothing. It stays exactly the same because the people that are paying the dividends, their share price may drop down. Now, my share prices may drop down 20%, 30%, 40%. So what? They're still financially strong. They're still paying dividends. They're still making profits. Why would I sell it? It makes no sense. Except if you're fearful and you think that it is possible for a business to totally disappear overnight, they don't have my experience of looking at millions of businesses and scoring them and judging them. It doesn't happen that way. It takes a long time for a Eaton's to go out of business or a Hudson Bay or whatever. Okay. It doesn't happen overnight. And not only that, you're aware of what's going on. As I said, if the score drops and they're no longer financially viable and they're not paying the dividend, yes, sell, get out. But that isn't going to normally happen. It'd be unusual. And then because you've got 20 stocks and one stock goes, what have you lost? 5%. That's what you've lost. However, if you're gaining 7%, what have you really lost in your total dividend? Nothing. It's the total dividend. It's the total portfolio that is important, not the individual stocks within it. That's where the strength is in the diversity.
Yeah, absolutely. Now, most recently, I think it was about 2 weeks ago, BCE cut their dividend, right?
Yep.
Absolutely. Now, most recently,
It
it
was
was
13
extraordinarily high.
and it dropped down to 5.5. And I
Yes.
own BCE and I've
Mhm.
owned it for maybe 10, 20 years. And it is slightly below what I paid for it, but not that much below. Now, why haven't I sold it? Because
Yeah,
I,
that's why.
again, the score is over 50
Hmm.
and the dividend is still over 5%.
So you still
And
feel
the other
that the
thing,
dividend is safe?
soon as they said that they were cutting the dividend, what happened to the stock? it went up about $1.90 immediately. It was at about 28 cents and it ended up, I think it's now about 31 in
Mm-hmm.
a bit. And I expect it's going to come back and keep going up. But
Mm-hmm.
no, I'm not worried particularly about it. Because even
Okay.
before it went under, in the reading I do every day, I probably, just out of interest, read maybe a dozen different sources of information on stocks. And I have been reading what other people see on it and what the analysts say. You'll notice in my scoring system, I do take into consideration what analysts say.
Mm-hmm.
But what they say only accounts for 10% of the 100%. And of that, it's split into those who have buy recommendations and those that make strong buy recommendations. And because of a change that they did, to me, a strong buy recommendation is one where they're recommending a price 50% ahead of the current price. That to me is a strong recommendation. And you do see them. In my podcast that I do every Saturday, I go through and identify the top 5 US stocks and the top 5 Canadian stocks by their high dividend, and there's 5 selectors I use to get them. But invariably, every month, every week when I'm looking at it, I'm seeing stocks that are, you know, doing very well and everything is going great, and other ones that aren't so great. But you've got to become familiar with what you're about, what's going on there, and it doesn't take that much to do. I've done
Mm-hmm.
all the work. Like in my books, I've got all the charts laid out. It's easy. It's simple to check something out. Even though some of the books are written 2 or 3 years ago, they're still of historical value. Because if you look at a stock 3 years ago, it was strong then. Is it still strong? Is it stronger? That is all very valuable information.
Yeah, so this is a great, like you're the scoring system that you're using, it's helping you to identify quality companies, quality stocks
Quality,
that are
quality
worth looking
companies,
at.
that's right. And
Yeah,
then with a little bit more research, I'll buy them.
yeah. So how difficult is it for somebody brand new who's never invested before? Because a lot of people get scared that it's gonna take a lot of work. It's gonna take hours and hours a week of research. How much time would it take somebody to get started in investing on their own?
If I were an investment advisor, I'd say, oh, it'll take years before you could possibly be able to invest on your own. The last thing they want to do is educate investors and show them that they don't really know anything more about stocks than you do or I do at this point. They really don't. How long does it take? I've had, go back to the 80-year-old woman who knew nothing about investing. And I did it all verbally. I didn't have a book then, but it's everything I taught her, I transferred over into that first book, and I've carried through into the other books. It took her, going back and forth, maybe a couple of months of going back and forth. If she had really been dedicated, knew more about stocks and businesses, it would have been less. But I guess what infuriates me or makes me so disappointed is run across the speculators who think that I'm absolutely nuts. That this is not how you invest. You got to buy low and sell high. This what you're doing is crazy. I don't know. Maybe they're right, but it sure has worked.
Hmm.
That's all I know is it works,
Yeah,
and I don't
it's
spend
not.
much time on it.
Yeah, I was going to say at the end of the day, it's not rocket science.
No, it
It
isn't.
really isn't.
The thing is, when I was building these risk scoring systems, I had to set up a system to go into every courthouse in Canada and pick up all of the commercial writs and judgments. I had to convince 5,000 businesses to give me their age trial balances every 90 days to load into that database. I had to get collection agencies to send me their collection claims as I built that database up and got the information into it so that I could even start scoring. But look at it is now. Every public company in the world, there is a securities commission that is monitoring them. They have to report the information in every day, every night, every 90 days or so. The information is sitting there.
Hmm.
You don't have to do anything. I didn't have to go out and gather all this information. It was just waiting there for me. I couldn't believe how easy it was. It was a fraction of what I had to do scoring businesses that aren't public companies. There's 2 million businesses in Canada. There's only about what? Maybe 1,600? No, sorry. That's not true. There's about, in North America, there's 200. No, sorry. In North America, there's 22 million businesses out of roughly, and out of those, there's only about maybe 16,000 that are public companies. And all that information is there. All you have to do is gather it. And it doesn't cost anything. That's the other thing. I'm cheap. I'm not going to spend hundreds and hundreds of dollars for information that I can pick up for free. Yet every day I'm bombarded by companies trying to sell me information that is going to help me invest. It's nuts. It's
Yeah.
it's a con artist game, and it is a game to these guys. They're not in there trying to educate the public. They're just out there to get your money. And there's nothing wrong with that if you can do it and get away with it. If
Yeah.
you're naive,
So, yeah, I had a question about something we talked about just quickly earlier on. So, Ian, when you're looking at the historical data for companies that you're evaluating, how far back do you go? Is it 5 years,
I
10 years, 20 years?
I like to go back to 1999 because then you after that you have the drop in 2000. You got 2008, you got 2020, and I want to see what happened to their stocks. Usually, I can actually go back before 1999, go back to 1998, 1996, coming forward, just looking at it. What happens after each crash? How long did it take them to recover? Usually, it'll take a business a year, 2 years sometimes. And when you start talking like that, years to people, their eyes start to cloud over. Oh, years. But that's what you got to think. You got to think long term. Like right
Hmm.
now, we're still, as far as I'm concerned, we haven't fully recovered from the
Hmm.
last one
Yeah. Yeah.
because my portfolio is down from where it's been at its highest,
Mhm.
but it isn't
Yeah.
changing the income.
Hmm. So, just wanted to mention this. Like, this was about a month ago. I ran into an old colleague of mine, and she knew that I'm educating people on dividend investing, and she said to me, she said, "You know what? All of that sounds very complicated. Um, I'm going to put all my money. It's all in ETFs and index funds, and that's where she has all of her money in there." What would you say to folks that have the same kind of thinking that this is very complicated and I'm going to put it all in mutual funds, index funds, and ETFs?
I don't know, but I'm told it's safe. Oh,
Yeah.
have you looked at the prospectus? I've looked at prospectuses. And what do I see? I will see typically there will be 5 to 10 marquee companies that are in the news, that are in the first 10, and they would represent each about maybe 2%, 3% of the fund. And then you're going to have 95% of the fund is made up of a fraction of of like of hundreds of shares that they've maybe got not even 1% of in there. Now, why do they do it that way? The reason they do it that way is that the guy who is managing the fund has a job to keep. And as long as he measures up with what's going on average in the stock market, on average, he's going to keep his job and he's going to look okay. But if he should be adventuresome and decide to invest in only 20 companies, and the companies go down the tubes, then he's going to lose his job and so on. And do these companies and do these managers, do they sit down and do the stock scoring that I do and look at it? I would like to think so, but I don't think they do. I think they're just plucking numbers out of the air. There are thousands and thousands and thousands of mutual funds, and at this point, thousands of ETFs, all competing with each other. Why is it when you go to the Bank of Montreal or TD Bank or whatever, and their investment advisor sells you a mutual fund which is managed by the bank that he works for. Well, that's just as good as the other one being managed by this one or that one or whatever. It's all just a great big game to them. How do you separate you from your money? And if, they don't say to you, well, yeah, we do invest in Apple. Oh, what percentage of the stocks are in Apple? Oh, about 2%. Oh, well, they don't really emphasize that, do they? They want you to think that when Apple goes up, shoots to the sky, that you're going to go up with Apple. It doesn't work that way. These investment advisors are not in the business of educating people. Quite the contrary. They like to keep them like mushrooms, feed them manure and keep them in the dark. That's what it's all about.
Hmm. In your book, you talk about I think this is your first book, Income and Wealth from Self-Directed Investing.
Yeah,
You talk about strong warnings about predatory practices that you could encounter with investment advisors. And there's a story in there about an 80-year-old widow with $1 million portfolio, and she was not given the right advice by two major banks.
that's
Is
right.
that, do you feel that that is still happening today in this day and age?
Absolutely.
Hmm.
Why would it change?
Hmm.
Like I remember with her, you know, I talked to her and I told her that, listen, this guy is not helping you at this bank. I'd switch over to the bank that's closest to you. And I told her which one I thought was, to me, they're all going to be roughly the same anyway. And she did. And I said, whatever you do, do not go into the bank branch. Set up your self directed online, because as soon as you walk in there and they hear that you've got this money, you are going to be hustled. And sure
Hmm.
enough, she was hustled. They were so nice to this little old lady and, patting her on the back and so on. So then she transferred her money from the other bank to this bank. It took her, I think, something like 90 days to get access to her money. I told her, you want a self-directed account. What did they do? They put her into a managed account, and you're going to take their percentage and so on and so forth.
Hmm.
Ah, she learned her lesson. But, you have to learn your lesson before that happens. Is it predatory? I think all commission sales to a certain extent are predatory.
Hmm.
That's the way it is. But you got
So
to
I think
want,
it's up to us as individuals then to educate ourselves and
and not,
not
and not be
fall for
flat,
any of those.
and
Say that
not be
again.
and not be flattered by the bankers
Yeah,
who are going to
absolutely.
have
Yeah.
best interest at heart. They don't. They got their own
Hmm.
interest at heart. You were just a means to an end.
Mm, yeah, which is unfortunate. Ian, the other comment that I get a lot, and I've been a dividend investor for 26 years, and a comment I get frequently is some people will say that the dividend is irrelevant because as soon as the company pays you a dividend, the share price drops by that amount. And so some people say that you can invest in companies that don't pay dividends, just take out 4% every year, and you'll be fine. What do you say to those folks?
Okay. So then there's the other group that look at the date if the dividend is going to be locked in, and they buy it just before that because they're going to make that money. Yeah, you're going to, the stock may go down. It's gone down so little, I've never really noticed it, but I suppose it has. But it's also going to go back up again too. And it's so irrelevant and immaterial. I've never even noticed it as a problem. The
Mm,
fact that it goes down because they pay out a dividend. They're paying the dividend out of the capital. Okay, they're
mm,
still paying the dividend. What do I care about the capital? I'm not I'm not buying the capital. I'm buying a stock and I'm buying the dividend income. The capital can go up and down all at once as long as I see a dividend that keeps going up. What do I care about the capital? Because the capital will go up if the company's well run and they take care of their expenses and they take care of their sales. I've had to do those sort of things. I understand that.
mm. Yeah, absolutely. And I think that the dividend, for me, it provides stability. Stock prices go up and down all the time. But if there's no dividend, then you're hoping for the stock price to keep going up, especially when you
Well,
want to sell it.
and of course, the other thing in Canada is we get a great break if we invest in Canadian companies on
Mm,
the Toronto Stock Exchange. If you're married, you can get almost what, like $120,000 tax free out of it. And somebody
that's right.
said, "Well, that's ridiculous. Whoever gets that kind of money out of their portfolio?" I do.
Yeah. And I'm glad you mentioned that because that is for non-registered accounts. This is outside of your RSP, outside of your TFSA. And I looked at the numbers in Ontario, it's about $135,000 a year for a couple in Canadian dividends, and there's no tax on that.
No tax on it. Which
Yeah.
you just got me thinking about the other strange thing that was in there. Oh yeah, I'm 80 and I still have money in a registered retirement savings plan. Every year I have to take out a percentage. What I do all year is I save the dividend income in the registered retirement savings plan, and on January 1st of every year I withdraw whatever I have to take out of it. And it's always a surprise to me that I have, usually it's 5 to 7% in that range that you have to take out. I've still got money, cash sitting there. In other words, I am making more than 6% on my dividend income out of that. And in my RIF was maxed out to the top, and it isn't going down. At 80, it's still going up.
Hmm.
And is that bad? One thing. Well, you got to worry about when you die, the government's going to get 50%. I'm not worried about that. I will die. What will happen will happen. But until then, I know I've got the security of having a large fund of money that if I ever have to draw on it, I can draw on it. And I don't need to draw on it.
Yeah. So, what advice, Ian, would you have for somebody who's starting out looking to invest today? Would you tell them to wait on the sidelines, or would you tell them to jump
No,
in and start looking at
no.
stocks?
Because if you're into investing for the next 20, 30, 40 years, what difference does it make when you start? If you buy the right stocks, they're going to go up anyway. They may be down now or go down even more, but eventually they come. Usually I find that whenever I bought a stock, invariably it went down. Did I sell it? No. You just hang it. I'm buying quality. I'm buying a dividend. I'm not trying to buy the capital gain. Um, I've made capital gain, but it's just capital gain.
Hmm.
In other words, the share price to me is irrelevant, almost irrelevant. It means very little other than as a marker.
Yeah, it is. It is. And I think it's the key here is the stability of the dividend income. And as you mentioned, dividends grow with a lot of the companies that are quality companies. And so every time the dividend is increased, your dividend income is going to go up.
That's right. And I'll find that if a share price goes up like 100%, you'll see the dividend payouts going up 300% because they
Hmm.
have to. It's very interesting to see that.
Hmm. Yep. It is. It is. The increasing dividend tends to support the higher stock price. Or either way you want to look at it, right? The
It
stock
can,
price
but
will
not
go up.
always. There are some stocks that are paying very good dividends, and much to my surprise, you know, analysts don't look at them. They don't pay any attention to them. Another one is REITs, registered um, real estate and trust,
Yep.
income trusts. Um, I own several of them. They pay a good dividend. I don't get the tax break that I do on the stocks, but
Hmm.
that's fine. They're still a good source of income.
Yeah, absolutely. So one last question, Ian, because I know we could talk about this for hours and hours. This is a very favorite topic of mine. But one last question then for um, we've talked about giving advice to people. Don't wait on the sidelines. Get started right away. What are some one or two common investing mistakes that you see people making?
I think one of the ones that I see and have heard about are you'll get somebody who gets really excited about the next technical stock that's coming out there, and they'll take all their money and put it in there, convinced that this thing is going to go to the sky. Where I said, no, I'm going to, if I had $500,000, it's going to go into 20 stocks equally. I am not going to try to guess which one is going to do fantastically well. And not only that, you take a Tesla or somebody like that. Its book value is something like $8, and its share price is what? It's been up as high as $450. This is not a financially strong company the way it's operating right now. And, I predicted 3 years ago that Tesla was going to run into competition from Chinese electrical vehicles. And sure enough, it's happened, and it's driving their price down. This is the other thing. I've worked in competitive environments. It is, you have competitors. You're playing against them all the time, and they're playing against you. Whatever they do, you have to counteract with it, and so on. I don't think that Tesla is getting enough attention right now from the man who owns it, and I wouldn't invest in it.
Yeah, so that's good advice, right? Those are common mistakes that people will get into, is thinking that I'm going to put all my money into one stock, one growth stock. It's going to become the next Tesla or Nvidia or the next cryptocurrency, and I'm going to be able to triple my money in 6 weeks. Just not going to happen. You're taking
Crypto
on so much.
Cryptocurrency is another one. Why wouldn't I invest in cryptocurrency? I can't measure it. If I can't measure something or score it, why would I invest in it?
Hmm.
Can you measure a cryptocurrency? I don't know how you would do it. There's no information.
Yeah, that's right. And I agree with you. I feel the same way. And then why would you invest in it, right? That just doesn't make any sense. So, Ian, thank you so much for your time. I really appreciate it. Where can people find out more about you? I know you've got 6 books on investing. You've got 3 novels. You're also an artist. You're a podcaster. So give us some of the links or mention them, and I'll put them in the description below so that people could get in touch with you.
Okay, I have a website with 2 addresses. It's www.informus.ca, or it's www.saferbetterdividendinvesting.com. And my life is more or less what I've talked about today. A lot of that is there. The other thing is listen to the 222 weekly podcasts at Safe Dividend Investing. The first 190, I answered questions, constant questions. After that, because I was told it was getting to be repetitious, there's only so many questions you can ask in investing. Then I started doing the weekly discovery of the 5 largest Canadian, 5 largest U.S. dividend payers who were the strongest and showed the most gain in the last week. And that I find interesting because I'm curious to see who it is going to be every week as well. And then what's interesting is to see the same names appearing week after week after week. Not always, but sometimes. So that's an indicator to me. That looks like a strong stock.
Okay, that's great. We'll put the links down. I've got a link to your podcast as well, and we've got a link to your website. And I think from the website, you do have the book title. So if anybody's interested,
All the titles, yeah. And you can tap into my art there as well. I've got over 2,000 images at Fine Art America. And I started doing more in digital art because after you've been painting, what do you do with all the paintings? Yeah. Digital art, I can just store them automatically. But I like digital art.
Yeah, that is great. I've looked at them. I told you before we hit the record button. They're fantastic. I've looked at your paintings, looked at your photographs. You're so talented. Ian, I want to thank you so much today for taking the time out of your schedule to talk to us, to talk to our audience. Your story is inspiring, and you've given us so much to think about and such good knowledge. for someone who has been around for a very long time and you've got so much experience. Thank you, Ian, for being on the podcast today.
And thank you for inviting me.